The real estate market has a lot of people confused right now, and even worse, some of them are fearful. People are really worried about a housing market crash like the housing bubble of 2008. So will there be a housing crash? Stay tuned for today's video for some answers to the 5 top housing questions to find out. Top housing question number 1. Is the housing market going to crash? With all the headlines and talk in the media about the shift in the housing market, you might be thinking it's a housing bubble like the housing bubble 2008. It's only natural for those thoughts to creep in that make you think that it could be a repeat of what took place in 2008. The good news is there's concrete data to show that this is nothing like last time. Number 1, there's still a shortage of homes on the market today, not a surplus. For historical context, there were too many homes for sale during the housing crisis, many of which were short sales and foreclosures, and that caused prices to fall dramatically. Supply has increased since the start of the year, but there's still a shortage of inventory overall, primarily due to the 15 years of underbuilding of new homes. Now, this graph uses data from the National Association of Realtors, or NAR, to show how the month's supply of homes available now compares to the crash. Today, national unsold inventory sits at just a 3.2 month supply at the current sales pace, which is significantly lower than last time. There just isn't enough inventory on the market for home prices to come crashing down like they did last time, even though some overheated markets may experience slight declines. In Thurston County, we are at 1.5 months of inventory. A balanced market is 4 to 6 months. So we still have a significant shortage of homes to hit a balanced market, let alone a buyer's market. Number 2, mortgage standards were much more relaxed back then. During the lead up to the housing crisis, it was much easier to get a home loan than it is today. Running up to 2006, banks were creating artificial demand by lowering lending standards and making it easy for just about anyone to qualify for a home loan or refinance their current home. Back then, lending institutions took on much greater risk, both the person and the mortgage products offered. That led to mass defaults, foreclosures, and falling prices. Today, things are different and purchasers face much higher standards from mortgage companies. This graph uses Mortgage Credit Availability Index, MCAI, data from the Mortgage Bankers Association, or MBA, to help tell the story. In that index, the higher the number, the easier it is to get a mortgage. The lower the number, the harder it is. In the latest report, the index fell by 5.4%, indicating standards are tightening. Number 3, the foreclosure volume is nothing like it was during the crash. Another difference is the number of homeowners that were facing foreclosures after the housing bubble burst. Foreclosure activity has been lower since the crash, largely because buyers today are more qualified and less likely to default on their loans. This graph uses data from ATTOM, or ATTOM data solutions to help paint the picture of how different things are this time. Not to mention, homeowners today have options they just didn't have in the housing crisis, when so many people owed more on their mortgages than their homes were worth. Today, many homeowners are equity rich. That equity comes in large part from the way home prices have appreciated over time. According to CoreLogic, the total average equity per borrower has now reached almost $300,000, the highest in the data series. Rick Sharga, Executive VP of Market Intelligence at ATTOM Data, explains the impact this has. Very few of the properties entering the foreclosure process have reverted to the lender at the end of the foreclosure. We believe that this may be an indication that borrowers are leveraging their equity and selling their homes rather than risking the loss of their equity in a foreclosure auction. This goes to show homeowners are in a completely different position this time. For those facing challenges today, many have the option to use their equity to sell their house and avoid the foreclosure process. If you're concerned we're making the same mistakes that led to the housing crash, these graphs should help alleviate your fears. Concrete data and expert insights clearly show why this is nothing like last time. Top housing question number 2. What's happening with mortgage rates now and in the future? One of the biggest factors of the housing market cooldown we're seeing is the swift rise in mortgage rates. And as that volatility continues, many people are asking, are mortgage rates going to keep rising? But to answer this question, you have to first understand the why behind the reason mortgage rates have doubled since the beginning of the year: inflation. In an effort to ease inflation, the Federal Reserve is taking steps to try to tame inflation by slowing the economy, and those decisions are having an impact on mortgage rates. And until that's under control, rates will continue to respond to inflation. If inflation eases, rates may as well. This year, the rising mortgage rates have slowed the red-hot housing market. Over the past 9 months, we've seen fewer homes sold than the previous month as home price growth slowed. All of this is due to the fact that the average 30-year fixed mortgage rate has doubled this year, severely limiting home buying power for consumers. And the average rate for financing home briefly rose over 7% before coming back down into the high 6% range. Take a look at this chart. It shows how quickly mortgage rates rose from January 2022 to now. Inflation is the enemy of long-term interest rates. As long as inflation is high, we'll see higher mortgage rates. Over the past couple of weeks, we've seen indications that inflation may be cooling, giving us a glimpse into what might happen in the near future. The mortgage market is eagerly awaiting positive news on inflation. As Ali Wolf, chief economist at Zonda, says, the housing market is expected to face continued uncertainty heading into 2023 as consumers, financial markets, and policymakers work through their respective challenges in today's economy. We are watching for any additional stability in the MBS market, signs of cooling inflation, and/or less aggressive Federal Reserve action to give us confidence that mortgage rates are past their peak. What does that mean for the future of mortgage rates? As we get through the inflation battle and start to see that coming down, we should expect mortgage rates to follow. We've seen nods of this over the past couple of weeks. As the Federal Reserve works to bring inflation down, mortgage rates will come down as well. Bill McBride from Calculated Risk says, "My current view is inflation will ease quicker than the Fed currently expects." Well, as we look forward to the next year, we certainly hope he's right. Mortgage rates will come down, it's just a matter of time. The hope is that we will continue to see more positive news on inflation, and that'll bring mortgage rates down. This will give prospective homebuyers more buying power and lead to more homeowners throughout the country, which is always a good thing. Top housing question number 3. If the economy slows further, what does that mean for real estate? Post-2009, nothing will strike fear into the hearts of buyers and sellers like the word recession. But as the economy slows down, history tells us that this would likely mean lower mortgage rates for those looking to refinance or buy a home. While no one really knows exactly what the future holds, one thing will forever remain the same. People will always need a place to call home. Since the 2000 housing bubble burst, the word recession strikes a stronger emotional chord than it ever did before. And while there's some debate on whether we're officially in a recession right now, the good news is experts say a recession today would likely be mild and the economy would rebound quickly. As the 2022 CEO outlook from KPMG says, global CEOs see a mild and short recession, yet optimistic about global economy over a 3-year horizon. More than 8 out of 10 anticipate a recession over the next 12 months, with more than half expecting it to be mild and short. To add to that sentiment, housing is typically one of the first sectors to rebound during a slowdown. As Ali Wolf, chief economist at Zonda, explains, housing is traditionally one of the first sectors to slow as the economy shifts, but is also one of the first to rebound. Part of that rebound is tied to what has historically happened to mortgage rates during a recession. Mortgage rates typically fall during recessions. Historical data helps paint a picture of how a recession could impact the cost of financing a home. Looking at recessions in this country going all the way back to 1980, this graph shows each time the economy slowed down, mortgage rates decreased. Fortune explains mortgage rates typically fall during an economic slowdown. Over the past 5 recessions, mortgage rates have fallen an average of 1.8 percentage points from the peak seen during the recession to the trough. And in many cases, they continue to fall after the fact as it takes some time to turn things around, even when the recession is technically over. While history doesn't always repeat itself, we can kind of find comfort in the trends of what's happened in the past. History shows that you don't have to fear the word recession when it comes to the housing market. If you have questions about what's happening today, let's connect so you can have some expert advice and insights that you can trust. Top housing question number 4. What's ahead for home prices? After years of record-breaking price appreciation in the country, we've been seeing a very different scenario play out in the last few months. In order to truly understand why this is happening, this quote from David Ramsey explains it all. The root issue of what drives house prices almost always is supply and demand. Now that the end of 2022 is within sight, you may be wondering what's going to happen in the housing market next year and what this may mean if you're thinking about buying a home. Here are some thoughts on the latest expert insights on both mortgage rates and home prices so you can make your best possible move. Number 1, mortgage rates will continue to respond to inflation. There's no doubt mortgage rates have skyrocketed this year as the market responded to high inflation. Take a look at this chart. The increases we've seen were fast and dramatic, and the average 30-year fixed mortgage rate even surpassed 7%. In fact, it's the first time they've risen this high in over 20 years. In their latest quarterly report, Freddie Mac explains just how fast the climb in rates has been. Just 1 year ago, rates were under 3%. This means that while mortgage rates are not as high as they were in the 80s, they have more than doubled in the past year. Rates have never doubled in a year before. Because we're in unprecedented territory, it's hard to say with certainty where mortgage rates will go from here. Projecting the future of mortgage rates is far from an exact science, but experts do agree that moving forward, mortgage rates will continue to respond to inflation. So if inflation remains high, unfortunately, mortgage rates likely will too. Number 2, home price changes will vary by market. As buyer demand has eased this year in response to those higher mortgage rates, home prices have moderated in many markets too. In terms of the forecast for next year, expert projections are really mixed. The general consensus is home price appreciation is going to vary by local market, with significant changes happening in what they term overheated areas. As Mark Fleming, chief economist at First American, says, house price appreciation has slowed in all 50 markets we track, but the deceleration is generally more dramatic in areas that experience the strongest peak appreciation rates. Basically, some areas may still see slight price growth, while others may see slight price declines. It all depends on other factors at play in the local market, like the balance between supply and demand. This may be why experts are so divided on their latest national forecasts, as you can see in this graph. If you want to know what's happening with home prices or mortgage rates, let's connect so you have the latest on what the experts are saying and what that means for our area. Top housing question number 5. Should I wait to buy a home? This is probably one of the biggest questions you have right now, and it's definitely a good one. Today's cooling housing market, the rise in mortgage rates, and mounting economic concerns have people questioning, should I still buy a home this year? Despite the volatility we're seeing in today's housing market, it's important to remember the many financial and non-financial benefits of homeownership. Yes, affordability is a challenge right now, for sure. It's true that it costs more to buy a home today than it did last year, but the same is also true for renting. This means that either way, you're going to be paying more. The difference is with home ownership, you're also gaining equity, which can help grow your net worth. Not only is the equity going to help your net worth, but another benefit is rents are going to continue to go up. We're continuing to see that, and it's going to continue to happen. Whereas if you have a loan, your mortgage payment is going to stay the same, and it's going to be consistent for the 30 years. While it's true this year has unique challenges for homeowners, it's important to factor the long-term benefits of homeownership into your decision. Consider this. If you know people who bought a home 5, 10, or even 30 years ago, you're probably going to have a hard time finding somebody who regrets their decision. Why is that? The reason is tied to how you gain equity and wealth as home values grow with time. The National Association of Realtors, or NAR, explains home equity gains are built up through price appreciation and by paying off the mortgage through principal payments. Here's a look at how just the home price appreciation piece can really add up over the years. Home price growth over time. Even though home price appreciation has moderated this year, home values have still increased significantly in recent years. This map uses data from Federal Housing Finance Agency, or FHFA, to show just how noteworthy those gains have been over the last 5 years. If you look at the percent change in home prices, you can see home prices grew on average by almost 64% nationwide over that period, and 81.7% in Washington. That means a home's value can increase substantially in a short period of time. And if you expand that time frame even more, the benefit of homeownership and the drastic gains you stand to make become even clearer. This map shows the percent change in home prices since 1991. Washington has a whopping 481% increase. Nationwide, home prices appreciated by an average of over 290% over roughly a 30-year span. While home price growth varies by state and local area, the nationwide average tells you the typical homeowner who bought a house 30 years ago saw their home almost triple in value over that time. This is why homeowners who bought their homes years ago are still happy with their decision. Even if home price appreciation eases as the market cools this year, experts say home prices are still expected to appreciate nationally in 2023. That means in most markets, your home should grow in value over the next year, even if the pace is slower than it was during the peak market frenzy when prices skyrocketed over the last few years. The alternative to buying a home is renting, and rental prices have been climbing for decades. So why rent and fight annual lease hikes for no long-term financial benefit? Sometimes with ridiculous hikes. I've heard from a few people that their rent hike was anywhere from $400 to $700 per month. That is not good. It's definitely not a good surprise. Instead, consider buying a home. It's an investment in your future that could set you up for long-term gains. Don't let the shifting market delay your dreams. Data shows home values typically appreciate over time, and that gives your net worth a nice boost. If you're ready to start your journey on home ownership, make sure you check out the link in the description below for my home buying guide. It's a free guide and has tons of information to help you get started. Now, there is a lot of data in this video today. I believe that having data can help us understand what's going on and ease fears about what's going on in this market. It also helps to offset the scaremongering tactics that are put out on the daily from news outlets offering scary headlines trying to get you to click. Hopefully this data will put all of this in a new light and calm the fears you have about the market. If you'd like to get on my email list to get my monthly email where I share market information, local happenings, and all things home and real estate, click the link in the description below. I hope this was helpful. Thank you so much for watching. I'll see you next time.